Getting into the advisory now and navigating the markets at the moment, of course, a bit of a roller coaster. Andrew Wilson from Pitcher Partners joining me. Andrew, it has been a tough start to 2025. Don't envy the position that you and your colleagues are in, but just give us sort of an overview of how you sort of navigate all this uncertainty, particularly when we're still awaiting the impact of the tariffs.
Sure. So you're right, it has been a tough 2025, but things did start off kind of positively. Since the peaks though, we've got the ASX 200 down, as we know, it's down around 7%, and the S&P 500 down around 8%. But if investors are looking back a little bit further than just 2025, like the S&P 500 is still up, I think it's around 7% from 12 months ago. And with the ASX 200, although we're back at a price level to where we were 12 months ago, if we're looking at the accumulation index, which is a better indicator of an investor's total return, we're still in positive return territory when we're considering the dividends that investors are receiving as well. So, with all of the talk and to an extent speculation around tariffs, we have seen revisions to growth expectations, and that to an extent is what has caused part of this volatility, along with the big run up in markets and perhaps full to overvaluations. But with those revisions in growth, we're still not looking at recessionary levels. We're still in positive territory.
Yeah, a lot of chit chat about whether or not the US is going to go into recession and how that means you then allocate your portfolios. Do you continue to look at some of these smaller to mid-cap names as well as a potential bet against some of the volatility we might see?
It's an interesting space, the small to mid-cap space. I guess in our view, it's the part of the market where you're far more likely to generate good returns through active management and active stock selection. It's a bit of a, relative to the upper end of the market, it's an inefficient market. And there's, three things that I'd point to there as evidence of that. You've got poor performing companies that are coming down into the smaller mid-cap space from above. As they're coming down, they've got negative momentum, they're coming in, they're generally the larger weights in those indexes, but they're heading in the wrong direction. That's the first thing. The second thing is you've got companies in that small to mid-cap space that are really struggling some of them are struggling from debt levels and just keeping pace with their liabilities. And those companies in there that are good quality companies that do have good growth prospects, they're often, all of that growth is priced right in. So if any of it doesn't come to fruition, there's not a lot of room for error. So in that space, navigating probably those three factors in the small to mid-cap space is where you can generate some good returns.
So what's the sort of outlook for bonds amidst all this volatility? It's often where we hide here.
Yeah. So if we're talking high quality bonds, like your investment grade and above, and government bonds where you've got some duration, we've certainly been adding to that space for the last 12 to 18 months. And look, it has been quite volatile, and we have had questions from some of our clients around those allocations. But again, when you're taking a very long-term view, which we should be as investors, look back over the last 10 years and yield to maturities in those high quality bond sectors are still at decade-long highs. And yield to maturity is a good predictor of future returns. So we're still very comfortable allocating in that space. We think everyone's a little bit scarred from 2022 when both bonds and shares fell at the same time. But again, you look back over 50 years and bonds have typically been negatively correlated to share markets. So that you do get some protection in your portfolio by having bonds in there. And they're also liquid markets. So if there is a bigger sell-off than what we've seen so far in share markets, you've got some assets there that you can liquidate to redeploy into better opportunities.
What about the less liquid part in private credit? A lot of momentum here.
Yeah, absolutely. So it's a space that just keeps on growing and growing and growing. And I think the number one point that I'd make when you're looking at private credit investments is return of capital is more important than return on capital. So we invest in private credit markets, but we typically invest at the more conservative end of the spectrum. So your senior secured direct lending or warehouse facilities over asset-backed loans that are short-term in nature. You can go further out the risk spectrum in private credit markets to mezzanine debt and subordinated debt, out to special opportunities, distressed debt. But you really only, as an investor, you only want to go you only want to go out as far as, maximise your yield to the extent that you're confident that you're going to get your capital back, because an investment is only high yield if you avoid the defaults. As soon as you start getting defaults, you start to whittle down your high yield. So if you're looking at an investment in private credit that's offering a 15 or 20% return, then I suggest there's a fair chance you're not going to get your money back.